Good morning, everybody. I'm Rebecca Galvin, and I'm here today to talk to you about... Lovely. So we'll start off with understanding how you assess affordability in a changing market, understand what market challenges you're facing, and help you to understand how to optimise the use of data to ensure streamlined customer journeys. Let's look at the market challenges. If we start off with economic uncertainty, the recent pandemics led to a sectorial crisis with various local areas and demographics, so different ages, affluences, disproportionately exposed to unemployment risk. So, for example, those on a younger income, perhaps in the hospitality industry, exposed more, or people living in, say, Hounslow, Crawley, have a disproportionate amount working in aviation. So obviously, unemployment risk is potentially high there. On top of this, there's various sectors at risk of Brexit disruption. And this can all lead to a reduction or loss of income, causing obvious concerns and challenges. There's also an acceleration to online as businesses seek to adapt, survive and thrive. Seamless customer journeys are ever more important. So let's come on to the regulation. Regulation's high on the agenda for many lenders with a heightened focus on specific lenders. The regulation needs to be proportionate and reasonable assessment. It also needs to look at affordability outcomes that are both transparent and auditable. We need to balance the low friction customer journeys with accurate and reliable information. So what you need to do is you need the right data at the right moment to make the best decisions. At Experian, we've got a wealth of data and insight available. We've got traditional data, looking at things like trended data, commercial, rental, personal affordability, and then the non-traditional data, so personal affordability on the transactional open banking side. And today I'm going to be focusing on the personal affordability, the bureau side of the data, to really help manage those streamlined customer journeys. So affordability is really important across the whole customer life cycle, and it's really key to managing affordability risk from eligibility and application decisioning through customer management and onto collections. It's really important to assess affordability across the customer life cycle, but again, in the interest of time, I'm going to focus on the eligibility and application decisioning element of the journey. So, with the regulation, you need to do both a reasonable and proportionate assessment. And really, you need to assess affordability from two angles. You need to look at the consumer affordability risk and both the product affordability risk. So consumer indicators that could indicate high affordability risk would be things like credit risk, indebtedness, those in potential or in financial difficulty, lower levels of income. And then on the product side, you need to think about the size of the lending commitment, the term, the interests and fees, etc. And so obviously you use some data to understand, classify that risk assessment. And you really need to balance the regulatory risk with the operational impact. If product affordability risk and consumer affordability risk is both low and affordability is obvious, then there may be the potential for no further action. If affordability risk is high in this outer box, then that's where you want that really detailed, robust assessment, a granular view of affordability assessment. And you may need to lean on manual assessment or review of income and expenditure data. And again, that can be helped through the use of that open banking data. I'm not going to really be focusing on the open banking side today, as Rob Haslingden's covering that in a later session. But where I really want to focus, and again, these segments, the size isn't representational, the bulk of the assessment is probably going to be with these low intervention risk controls. And I'm going to talk through what kind of data can help support that decisioning. Okay. So we've got a wealth of data here. We've got income and estimation and verification. So this is essentially when a customer's providing an income to you, to the lender, we have data that can verify that that income is consistent with what they're saying, that income isn't being overstated, etc. Substantiate that income before you carry out your affordability assessments. Then we have income shock and stability metrics that I'd like to talk about, again, particularly relevant in the current climate. So has your income dropped off recently, or how stable is that income over time? Is it on an increasing trajectory, or is it on a reducing trajectory? Then we can go on to looking at the effective disposable income. So really there you are assessing capacity or ability to pay. We've also got a tool for if you're not capturing income, or your income that you capture you can't verify, how do you assess affordability in that circumstance? And we have some RAG statuses which I can talk you through as to how that would work to understand what somebody's capacity to pay. And then we have some debt to income ratios. And as I say, when we were classifying that affordability risk and the level of assessment that needs to be undertaken, these debt to income ratios, together with our consumer indebtedness indices, can help support that process with all the other measures that I talked about on the previous slide. Okay, so let's start off with income estimation and verification. View of income is required. So we have estimates covered on different time spans, looking over 12 months, looking over 6 months, and looking over a more very recent view of 3 months. But we've realised that no one size does not fit all, and that is why we're presenting back multiple views of income from current account turnover estimates to be able to provide you with flexibility in decisioning and to really tailor your needs to your strategy and make the most comprehensive strategy available. So different metrics may be more applicable in different circumstances. So for example, if you have a job that doesn't pay a regular, consistent income, for example, seasonal or gig economy workers, then it may be more preferable to use highest total turnover value across various specific current accounts in question. So for example, across same person accounts or across all same person sole accounts. If there's been a recent change in salary, so an increase or a decrease, it might be more appropriate to look at the last month's view. But you do need to be careful there, as it's only a single month, and there's obviously presents quite a bit of volatility in that measure. You might have switched the current account that you might have switched the account that your salary is paid into, and in which case we have metrics that look across accounts and can provide that that view and that consistent view. We've done some analysis that's shown customers often apply for products off the back of a life event. So, for example, if you're recently promoted, you might go out and buy a new car or what have you. And again, with that in mind, a more recent view of income might be appropriate. So on the next slide, I'll talk a bit more about the stability and the income shock metrics and how that can support in your decisioning as to which metrics you may well want to use. There's also information that we can provide to give you more detail and insight around the account that these estimates have been based off. So are they sole accounts? Are they joint? Do they have regular payments? Is the turnover into those accounts stable, so relatively stable across the period? Is it fluctuating, which means it's not stable, or is it irregular, which is essentially fluctuating but drops to very low levels? And those circumstances are where you may want to use different metrics. There's other insight, for example, understanding the account that you're looking at. You might want to exclude certain types from the income that you verify. So if, for example, the income estimate was only made off a joint account, you might say, well, for that population of customers, I'd like to do a different and more detailed assessment in that regard. So I think the story is that one size doesn't fit all. Again, returning all this level of insight to you enables you to tailor your strategy. So I've actually just talked about the income estimates themselves. If we're looking at the verification side, for each of these estimates, we can return a verification level back, which says, is that income verified? Is it overstated or significantly overstated? And the parameters at which you apply that to can be flexed as well. So, for example, I'm going to verify up to 100% if it's overstated between 100 and 110, or is it significantly overstated if it's above that? So again, using all that data in combination really helps you verify your income. Next, we come on to income shock and stability metrics. So we have here the results for the last 3 months maximum turnover can be returned. I'm just showing you a latest month example of a view whereby you can set different thresholds for an amount to be returned. Again, this is all using current account turnover data in a compliant way, returned to you for use in your decisioning. So these parameters are set at the green is above 1,000, the amber is 200 to 1,000, and the income dropping below 200 is flagged as red. So you've got 60A around sort of just under 70% in the green, about 15% amber at the moment, and 18% in flagged as red. So these are indicative figures here just displayed. But what you can take from that is you can look at the previous month and say to last month, has somebody had an income shock? For example, has somebody moved from green to amber, green to red, or amber to red? And that might affect, say, 5% of your population coming through. And again, use that in your decisioning to apply caution, potentially move them to high affordability risk, reduce or cap limits, etc. And then what I talked about before on the stability metrics, we have increasing turnover and decreasing turnover. And this looks at an account over a period of time and compares it to a previous time period. So, for example, in this example, it's saying what's the, looking at the last 6 months compared to the previous 6 months, which roughly equates to pre-pandemic post. And you can kind of see, has there, report on the level of stress customers that have moved to sort of had a greater than 200 or 10% decrease, and highlight those customers. So again, that can support which incomes you use in your income verification, and also add insight to your strategy. So we've looked at income, we've verified the income, so now we can really get on to understanding somebody's capacity to pay. So we have an effective disposable income. So we take the monthly income, we deduct the monthly mortgage or rent. So if there's rental bureau data on the bureau, we'll retrieve that. If not, then it's estimated using ONS data. We then deduct the basic essentials spending, so items such as council tax, travel, etc. Then we deduct the basic quality of living expenditure. So really these are items that are hard to reduce. So whilst not classed as essential, it's something that's really difficult to cut back on. So personal care, childcare, repairs, etc. And then off of the back of that, you have the credit commitments in the bureau. So deducting revolving and non-revolving payments. And off the back of that, then you get a disposable income. And then in your strategies, you can say, well, does that support the new lending that I'm about to offer? Adding in buffers if you think necessary, etc., to your strategy. But what if you don't collect income or you can't verify your income? Can you still assess affordability? Okay. So we have a way of using the current account turnover data in a compliant fashion, whereby we can return to you RAG statuses against various payment amounts to give you an understanding of a consumer's affordability. So you define what proportion of your disposable income would be that the consumer could afford, what they couldn't, and what they may be able to afford. So basically your red, amber, green statuses. You provide the different monetary values that you want to assess against. So for example, do you want to assess a £50, £100, £150, £200 payment options? We then process that data against our Cato information and return the statuses. So this is best provided, explained by an example. So this example here is an applicant for £1,000 over 3 years, equating to a monthly payment amount of £40. We know they have an income estimate on the bureau at £15,000. We've produced that through the disposable income calculation, and we can confirm that they have £50 disposable income. So we're assessing in this example against a £20 increments, and so as they have £50 disposable income, they can afford a £20 payment. It's questionable over a 40 and 60, 80, and so on. They can afford. They can't afford those above those amounts. So essentially, you would tailor your strategy through to straight through processing or through to extra checks, such as proof of income and expenditure, whether that goes on an open banking journey or or to an underwriter, etc. And then whether you would decline that lending or take further assessment. So I've it's been in a bit of a whistle-stop tour, but I've taken you through all of the different elements that the Bureau can provide to essentially assess the middle segment, if you like, as I first described, for affordability. After that, obviously, from the results that come back from this, you may classify some population to go into a high, more granular affordability risk assessment, but hopefully the bulk of your applications can go straight through on the journey. Just wanted to finish off talking a little bit about eligibility. So obviously talked about the challenges that everyone's facing, and the online journey is really important. And essentially, if you have affordability baked into your customer journey, then that customer experience can be a lot better. So let's take an example. A customer lands on a jeweller's website. They're looking for a watch. They find one for £2,000. They apply for credit. A risk and affordability credit check is carried out. They're declined because they can't afford that credit. They have an unhappy customer. So if we're using eligibility, the customer can land on the jeweller's website. They can understand how much they can borrow and either be presented with watches up to an amount of £1,500 or know that they can borrow up to £1,500 and find a watch for £1,400 below that amount. And then they apply for credit knowing that they'll be accepted. And then you end up with a happy customer. So if you put in the same strategy, obviously it's just simplified that for the purposes of this presentation, but if you're putting in an affordability strategy at eligibility stage with the same parameters as that application, then you're really helping that customer journey on its way. Okay. So appreciate that's been a whistle-stop tour, but that's the end of our presentation. On to any questions.
Thanks, Rebecca. We do actually have a couple of technical questions that have come in from lenders. One is, what information do I have to send in to retrieve the affordability data?
Okay, so to retrieve the data, you'll be sending in obviously the income if you're capturing it, and that can be at a gross annual view or a net monthly. But then to make the disposable income calculation more accurate, we also ask for marital status, number of dependents, and residential status. So they're the main elements. Obviously, if you're doing a credit check, there's the usual name, address, date of birth as well.
Okay, thank you. And just one last one before we break for lunch. Do you get an income estimate based on current account turnover, and is that returned for everyone?
Yes, you can. So obviously there's rules around what data we can return. So hence why I've been through the RAG statuses, etc. But yeah, we can return information on the current account turnover data, providing it doesn't hit one of the exclusions. So, for example, if there was very low turnover or a high number of account holders and it wasn't a typical income, that may fall into an exclusion, or we don't have enough history for the estimate that you're looking at. And then there's also the issue of non-consented accounts. So these are old current accounts that we aren't able to share the information on. So obviously they would have to be dealt with through the strategy.
Okay, thanks very much, Rebecca. But there was a lot covered in that kind of whistle-stop tour.